The Chinese central bank just unleashed a bazooka onto markets by cutting rates. Plus, the latest research shows that Bitcoin loves liquidity, and we're setting up to see a massive bull run. And while some hedge fund managers are telling you to buy everything,
PDB, the two Chinese ETFs, everything China.
We discuss why you should be cautious and never trust central banks and big banks with your Bitcoin. Let's go. What's up, everybody? This is Dante Cook with Bitcoin Simply, helping you to understand macro and markets in a simple way. Let's get into today's episode. The monetary bazooka is turning on from China. China's central bank approved a 50 basis point rate cut, reduced the level of required reserves from Chinese banks, and also lowered mortgages for homeowners. Oh, and they're also unlocking a $113 billion for the Stock Stability Fund to boost equities. And so far, Chinese equities are responding, as the Chinese stock index is up over 4% since the news. And people like David Tepper, the owner of the Carolina Panthers, who bet everything on Bryce Young in the past draft 2 years ago, is also telling you to bet everything on Chinese stocks.
Okay, in the last week, I went more when they said a day or two ago on their Fed, and last night I did more.
Just Alibaba, or are you talking JD, Baidu? PDB, the two Chinese ETFs, everything China.
ETF, I would do futures, right? Everything. Listen, a long time ago, in 2010, I think I said everything.
And you would say everything. I remember when you said everything.
And you know what's good?
You were right.
Everything. Okay.
China's balance sheet growth is typically really bullish for Bitcoin. But that's not just China's balance sheet. Bitcoin loves liquidity from wherever it can find it. In fact, based upon the research from Lynn Alden and Sam Callahan, Bitcoin responds to global liquidity 83% of the time in any 12-month period going back to 2013. This is the highest correlation to global liquidity of any asset class. Bitcoin is the greatest absorber of global liquidity. We've said this many times. And in short order, it's responding accordingly, as Bitcoin is up over 65,000 as of this recording. And based upon the charts, it looks like we're about to break out of a massive consolidation phase. October, anybody? But let me give you a few examples of why I believe that we should always be cautiously optimistic when talking about Bitcoin within the context of the normal financial system. Let's go back to the announcement of the Chinese Stock Stability Fund. This is going to allow institutional players or non-banks to create facilities with the central bank. So non-banks can post collateral or securities in exchange for something like a Chinese government bond that they can then go out into the Chinese markets to use as collateral. So it's effectively a swap, but with a non-bank player. This has been done in the past, and according to Matt Dines from Build in his latest podcast with Nick Bhatia from the Bitcoin Layer, every time that this has been done, it hasn't turned out well. From John Law in Mississippi in the late 1600s to England and France in the early 1700s with the South Sea bubble. Every time that there's been a credit facility from non-bank players with the central bank to stimulate growth, it's always ended in collapse. And I'm not the only one sounding the alarm about being cautious when it comes to dealing with Chinese equities. Bill Miller took to Twitter to remind us to be cautious, but to also realize that one of the greatest qualities about Bitcoin is that you don't have counterparty risk. People who invested in Bitcoin miners in countries where they could be seized in 21, 22, 23 learned about country counterparty risk in a very real way. People who left their Bitcoin on exchanges like BlockFi or FTX learned about custodial counterparty risk in a real way. And I hope people don't have to find out the hard way with Coinbase, because time and time again, they give us lots of examples of why you shouldn't leave your Bitcoin on exchanges. Every time, coincidentally, when Bitcoin's price pumps, you're unable to buy Bitcoin or withdraw your Bitcoin from their platform. Be careful out there. In a non-Bitcoin related example to counterparty risk, from another part of the web, one of the largest open source projects or platforms in the world in WordPress, which powers 63 million websites, or 2 out of every 5 sites on the internet, decided to ban WordPress engine, or a developer of themes, plugins, and lots of useful tools on top of the WordPress platform, and also has 1.5 million customers. They banned them like that. These are examples of why Bitcoin maxis continue to bang the table on self-custody, on becoming truly sovereign with your Bitcoin, not just looking for number go up technology, but freedom go up technology. This is why the protocol is worth over $1 trillion to all the people out there who say it's worthless. Which leads me to the interesting thought of the day: why we shouldn't trust central banks and big banks with our Bitcoin. Remember back to last week when there was a potential exemption for the Bank of New York Mellon to get around the SAB 121 rules and custody Bitcoin on behalf of customers? Well, I didn't really think too much of it. But when I saw this tweet that JP Morgan, Citibank, Morgan Stanley, Wells Fargo, Bank of America are all experimenting with Bitcoin lending, this sent off a lot of red flags for me, because this reeks of fractional reserve banking. Every time big banks get an opportunity to use fractional reserves, they will. In a recent podcast with Marty Bent, Caitlin Long describes this is one of her fears and things that most Bitcoiners aren't thinking about. She believes that a big bank is going to collapse because of fractional reserve banking with Bitcoin.
Bitcoin is a disinflationary asset. It is not an asset that inherently has yield. And if you are investing in Bitcoin yield, that yield is coming from somewhere, and you better go figure out where the yield's coming from and whether the yield is appropriately compensating you for the risk. They've never seen anything like Bitcoin. This is the apex predator, to borrow a phrase from Trace Mayer from years ago. This is the apex predator of finance. If they get themselves leveraged at all, more than 1-to-1, they're going to get in trouble at some point. And I guarantee you they're going to get themselves leveraged more than 1-to-1. They don't have the risk systems to segregate Bitcoin, and they don't have the philosophy to segregate Bitcoin either. The Fed did give supervisory non-objections, which means that it let Bank of New York Mellon get into the businesses that the Fed officially claims are so risky that they threaten financial system stability. So watch what they do, not what they say.
The banks are used to the Fed and the Treasury coming in and printing money and issuing bills when they get into trouble. They're going to find out the hard way that you can't print more Bitcoin.
So while I'm as excited as anybody else about the adoption of Bitcoin on Wall Street, I always urge you to be careful and be cautiously optimistic when it comes to your Bitcoin within the existing financial system. Fractional reserve banking is ridiculously profitable, and it's ridiculously addicting. Have you ever heard the term, "Give me a lever long enough and I will move the world"? Well, that's exactly how our financial world is moved, through leverage. You give me your assets and I take your assets and lend them out, or borrow against them, or create swaps or different facilities with things that you've put your hard-earned money, time, and effort into to store value for yourself and for your family. With Bitcoin, you don't have to fall prey to Wall Street's fractional reserve banking system. Remove your Bitcoin from platform and exchanges and take custody of your Bitcoin. Own your private keys. Verify your Bitcoin on the blockchain. That's what it's for. And with that, we're signing off for the day. This is Dante Cook with Bitcoin Simply. Happy stacking.